Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Applied Optoelectronics.
If you find our talks useful, please consider subscribe, like, and comment underneath. So I want you to imagine something for a second. Imagine you are building a multi-billion-dollar artificial intelligence supercomputer, right? You just spent an absolute fortune securing the most advanced, cutting-edge processing chips in the world.
Right, the absolute best hardware money can buy.
Exactly. You have the ultimate digital brains. But then you realize those brilliant minds are completely isolated. They're bottlenecked by these physical connections that they can't move data fast enough. You've essentially built a fleet of supersonic jets and, parked them all on a dirt runway.
Yeah, that's a really great way to visualize it.
Right. So today's talk is exploring the company that's essentially paving the superhighway for those chips. We're looking at a business that has pulled off this just spectacular corporate reinvention. I mean, they've pivoted from being this legacy telecom supplier into a critical high-growth enabler of the whole artificial intelligence revolution.
And honestly, the transition from telecom to artificial intelligence infrastructure, I mean, that is a massively, it's not a subtle pivot.
No, not at all.
Because historically, right, telecom optics were designed to send a relatively small amount of data across vast distances, think, thousands of miles under the ocean. But artificial intelligence requires the exact opposite.
It's all localized.
Exactly.
Wow.
You need to send an unfathomable tsunami of data, but only across a distance of maybe 3 or 4 meters inside a server room. So the engineering challenge is completely inverted.
Which is wild when you think about it.
It is. And when you look at the landscape of this technology, the media, they obsess over the software algorithms and the graphics processing units, but none of those function without the physical infrastructure translating those electrical signals into pulses of light. And Applied Optoelectronics has aggressively positioned itself right at that physical choke point.
And we are really seeing that aggressive positioning bleed directly into their financial realities. Because, we aren't just discussing some fun theoretical narrative here. The raw numbers are actually proving that this pivot is materializing on the balance sheet.
Yeah, the data is definitely backing up the story.
For sure. I mean, look at the fourth quarter of 2025. Their top-line revenue hit $134.27 million.
Yeah.
That is a 34% year-over-year growth rate. And full-year 2025 revenue came in at approximately $455.7 million. But, the total revenue only really tells half the story, right?
Right, because the internal revenue mix is where the true fundamental shift is actually happening. If you dig into it, their data center revenue specifically surged to $74.88 million just in the fourth quarter.
Wow.
Yeah, and that single metric confirms that the high-growth artificial intelligence segment has officially overtaken their legacy businesses. It's now the dominant engine driving the entire company.
So when you look at your own portfolio, you might see the big software names and think you're covered, but you really have to ask yourself if you are exposed to the physical plumbing running it all. Applied Optoelectronics kind of reminds me of like a city planning department realizing that a massive metropolis is just being built overnight.
Oh, that's interesting. How so?
Well, the genius scientists are arriving, right? Those are the AI chips. But someone has to build the high-speed billet trains that allow those scientists to actually talk to each other without gridlock. The company was always building trains, but now they're building them for the most important city on Earth. It's like a struggling indie actor suddenly landing the lead role in a massive Marvel blockbuster.
Yeah, the bullet train analogy captures the necessity perfectly. Because without the transit system, the whole metropolis just collapses under its own weight.
Exactly.
Yeah.
But, and this is a big but, Wall Street is not exactly known for being patient with unprofitable transit authorities.
No, they are not.
So this is where we need to look critically at the profitability metrics because honestly, they paint a pretty harsh picture.
They do look a bit rough on the surface.
Yeah. I mean, the revenue's exploding, sure, but they are reporting a negative 8.39% net profit margin. And even worse, their EBIT margin, which is earnings before interest and taxes, basically measuring the profit from core operations before the bank or the government, takes a cut that is negative 9.5%.
Right.
So wait, the factory itself is literally losing money on every single unit it ships right now.
Right.
How can losing money on core operations possibly be interpreted as a bullish signal for investors?
I know it sounds counterintuitive, but the crucial concept to understand here is operating leverage.
Okay, unpack that a bit.
So in complex hardware manufacturing, your costs always hit the income statement long before the profits do. It's just the nature of the beast. Right now, they are funding a massive technological transition. They have to retool factories, run, extensive research and development, secure raw materials to produce these high-margin, next-generation products.
Right, which isn't cheap.
Exactly. These are massive fixed costs. You have to spend the money up front before you can build the thing.
So the heavy financial bleeding today is basically just the cost of entry for tomorrow's market share.
Precisely. In industrial turnarounds like this, current profit margins are usually a lagging indicator. You want to look at the leading indicators like that 34% revenue growth and the massive data center surge to see where the demand curve is actually pointing.
Right.
Because once their manufacturing successfully scales up and those heavy fixed costs are covered, that's when operating leverage kicks in. Every additional unit sold after that break-even point drops almost entirely to the bottom line. So the profitability doesn't just, creep up slowly, it violently turns the corner.
I see. But operating leverage requires actual customers buying the product in massive volume, though. Like, we can't just blindly trust that the demand will materialize. We need to look at the backlog validating this whole turnaround.
And they have a massive validation point right now.
Yeah, they do. The company recently secured a staggering $200 million order for next-generation 1.6T transceivers, and that delivery is scheduled for late 2026. So let's break down that terminology for the listener because it's important. A transceiver is essentially the translator. A processing chip speaks in electricity, but fiber optic cables speak in light.
Right, they bridge the gap.
Exactly. The transceiver sits right between them, turning the electrical data into laser pulses. And 1.6T means it is moving 1.6 terabits of data every single second.
Which is just an unbelievable amount of information. The physics of moving 1.6 terabits per second are brutal. At those speeds, traditional copper cables generate way too much heat, and they suffer from severe signal degradation over just a few feet.
So the signal just dies.
Yeah, the data literally falls apart before it even reaches the next chip. The only solution at that speed is moving to optical infrastructure. Furthermore, Applied Optoelectronics is developing a 400 milliwatt laser, which positions them squarely in the highly lucrative silicon photonics market.
Wait, silicon photons, that's where they bake the laser directly into the chip, right?
Exactly. You embed the optical lasers directly onto the silicon chips themselves. And doing that drastically reduces power consumption and latency. It's the holy grail for data centers right now.
And that technological leap is likely why they also landed another massive deal, a $53 million volume order from a, quote, major hyperscale customer. This order is specifically for 800G transceivers to expand an artificial intelligence network. Now, the identity of this hyperscaler, which is the industry term for those massive cloud providers operating on a planetary scale, it's officially unconfirmed.
Right, they haven't named names.
But the speculation strongly points to NVIDIA. I mean, we know NVIDIA's data center revenue recently surged an astonishing 263%. Because these transceivers are absolutely essential to link those processing clusters together, the market is largely assuming the buyer is either NVIDIA directly or, primary partner like Microsoft or Amazon.
Yeah, and if you look at the timeline and the sheer scale of the capital expenditure, those specific companies are really the only logical candidates. I mean, you simply do not place a $53 million order for 800G transceivers unless you are building global infrastructure.
Right, you aren't buying that for a local IT closet.
Exactly.
But, getting a massive order is one thing, keeping the customer is another. I kind of look at their design win status, like getting written into the architectural blueprint of a skyscraper.
Oh, that's a good comparison.
Yeah, because you aren't the person selling replacement light bulbs to the janitor. You are the steel rebar poured directly into the concrete foundation.
Yeah.
Once that building is going up, they cannot swap you out without tearing down the entire structure.
That framing highlights the switching costs perfectly. In the high-speed optical interconnect market, absolute reliability is mandatory. A single point of failure in data transmission can bottleneck an entire multi-billion-dollar processing cluster, which basically renders those incredibly expensive chips useless.
Right, it ruins the whole investment.
Exactly. So when a hyperscaler validates a specific optical transceiver, they spend months testing it against their unique network architecture. Once they confirm it works flawlessly, it becomes incredibly risky and expensive to rip out those ultra-fast optics and introduce a competitor's product. The defensive wall around their business becomes practically insurmountable.
And Wall Street is clearly aware of this defensive wall because the reaction has been just explosive. I mean, the institutional money is flooding in, and it's completely altering the technical structure of the stock.
Oh, the charts have gone crazy.
Yeah. A key trading signal recently flashed at $101.87, which triggered this massive breakout. The price action surged over 12% initially, and then we saw reports of shares jumping between 13.5% and 18.88% in a single trading session. And the daily volume was gigantic, ranking 289th in the entire market.
And that volume metric is critical. Volume is basically the footprint of institutional money. Retail traders checking their brokerage apps on their phones do not generate enough capital to push a stock up nearly 20% on that kind of volume ranking.
Not a chance.
No. That requires hedge funds, mutual funds, and large asset managers aggressively accumulating shares. The stock has also been identified as fitting Mark Minervini's trend template, which just further validates the institutional presence.
Yeah, and for those who don't know, Mark Minervini is a legendary trader, but his template is not just about drawing, squiggly lines on a chart. It is a highly rigorous framework. It demands that a stock not only be in a massive, undeniable uptrend, but that the price action must be backed by fundamental, accelerating earnings and revenue.
Right. It demands that the underlying business is actually improving.
Exactly. It filters out the companies that are just moving on empty hype.
The Minervini template requires the fundamental turnaround story to be confirmed by the price action. The two must move in tandem. When a stock meets those strict parameters, it signals to quantitative funds and momentum algorithms that the structural re-rating of the company is totally legitimate.
And that momentum is actually breeding derivative products now. We just saw trader ETFs launch 2x leveraged single-stock ETFs, specifically targeting Applied Optoelectronics.
Which is a huge development.
It is, but let's explain the mechanics here, because this introduces immense volatility.
Yeah.
A 2x leveraged ETF uses financial derivatives and debt, so that if the underlying stock goes up 5% in the day, the ETF goes up 10%. But the catch is that to maintain that daily leverage, the ETF managers are often forced to buy more of the underlying stock as it goes up, which creates this mechanical feedback loop of buying pressure. To be entirely honest, seeing a leveraged single-stock ETF launch for a company that just jumped 18% in a day, that sets off alarm bells for me.
Yeah, it sounds like euphoria.
It sounds like top-of-the-market institutional FOMO. Are we just staring at a hype bubble ready to burst?
The skepticism is absolutely warranted, honestly. Leveraged ETFs amplify both directions violently. If it drops twice as hard. However, we really have to distinguish between a speculative hype bubble and an institutional accumulation phase.
Okay, what's the difference here?
A hype bubble occurs when retail sentiment detaches entirely from the business fundamentals. But what we are witnessing here is a psychological shift among major capital allocators. Smart money is moving out of a volatile sell-off phase, recognizing that the $200 million order is a tangible, contractual reality, and they are aggressively repositioning their portfolios to capture the upside.
So they're chasing, but with a reason.
Exactly. They are chasing the stock, but they are chasing it based on contracted future cash flows, not just a trendy narrative.
Yeah. But, contracted cash flows only matter if the company can actually build a product. Let's pivot to the bear case here and outline the severe risks facing this thesis. Because hardware manufacturing is notoriously unforgiving. Announcing a $200 million order for 1.6T transceivers is a great headline, sure, but producing them at scale without burning down the balance sheet is a monumental task.
The execution risk cannot be overstated. It is massive. The manufacturing yields on cutting-edge optical lasers are incredibly difficult to master.
Why is that?
Well, when you are operating at the bleeding edge of physics, you might manufacture 100 lasers on the line, but only 60 of them actually pass the rigorous quality control testing required by a hyperscaler.
Oh, wow. So you just throw the other 40 away.
Pretty much. And if they struggle with those manufacturing yields, or if there are any production delays, the market will punish them brutally. Wall Street is currently pricing in perfection for that late 2026 delivery timeline. Any stumble on the assembly line will just be catastrophic for the share price.
And that execution risk feeds directly into the second major threat, which is balance sheet degradation. The stock recently suffered a brutal week of selling tied specifically to, quote, equity dilution fears. Now, here's the glaring contradiction that you really need to understand. Financial reports explicitly note the company currently maintains a strong cash position.
Yes, they do.
So hold on. How can the market be terrified of the company running out of money and diluting shareholders if they are sitting on a strong pile of cash? It doesn't make sense.
It does seem contradictory, but it resolves when you examine the working capital cycle of a mega order. Having a strong cash position today is sufficient to keep the lights on for normal day-to-day operations. However, hyperscalers typically pay on delivery. Right, so to fulfill a $200 million order, the manufacturer has to secure massive manufacturing space, purchase highly specialized raw materials, and hire top-tier engineering talent months or even years before the client writes a single check.
So they basically have to front all the cash to build the inventory.
Exactly.
Yeah.
The cash burn required to ramp up production for 1.6T and 800G transceivers is just immense. Management will likely look at the capital required to fund this hypergrowth and realize their current cash reserves are completely inadequate.
And when you need cash fast.
You issue stock. The most common way to raise capital quickly, especially after your stock price has just surged, is to issue millions of new shares into the open market. But this immediately dilutes the ownership percentage of existing shareholders. So the recent sell-off reflects the market anticipating that a capital raise is pretty much inevitable.
It is the ultimate double-edged sword. You win the biggest contract in the world, but you have to dilute your investors just to afford to build it. Looking ahead, investors need to know exactly when these risks and rewards will be quantified. We need to map out the catalyst calendar.
Definitely.
The critical date circling on the horizon is the Q1 2026 earnings report, which is expected in late April or early May of 2026. What are we looking for there?
Well, the entire financial sector will be heavily scrutinizing that earnings call. The market is specifically demanding that management officially raise their full-year guidance to incorporate that massive $200 million order backlog.
And if they don't?
If they hesitate, or if the guidance comes in softer than expected, the technical momentum we discussed will reverse violently. It will be an ugly drop.
Beyond earnings, there are also industry-specific catalysts.
Right.
We saw the stock jump 9% initially, just from their presentations at the recent optical fiber communication conference.
Yeah, that was a nice pop.
For sure. And any follow-up announcements regarding the commercial deployment of the technology they showcased there will act as immediate upside triggers. The market will also obviously demand confirmation that the $53 million order is actually shipping to the hyperscaler without production hiccups.
Absolutely. So when you synthesize the entire landscape, the fundamental shift from telecom to artificial intelligence, the validated hyperscale order backlog, the massive institutional accumulation, and of course the very real risks of equity dilution and manufacturing yields, the final evaluation stands at an 8.5 out of 10 bullish score.
An 8.5. But given the volatility introduced by those leveraged ETFs and the dilution risk, what is the realistic time frame for that bullish thesis to actually play out?
The target horizon requires a medium-term hold of 6 to 9 months. This is definitely not a quick day trade.
Right.
The strategy requires holding through the upcoming Q1 2026 earnings cycle. You want to give the market time to fully price in that late 2026 order backlog. And more importantly, you really need to wait for confirmation that the margin expansion is actually occurring. The goal is to capture the inflection point where those heavy fixed costs are finally covered and the operating leverage turns those negative EBIT margins into explosive profitability.
It is a phenomenal case study in corporate endurance, honestly. They survived the boom and bust cycles of legacy telecom, only to find themselves holding the exact technological key required for the next era of computing, which, leaves a lingering thought to consider. We spend all our time analyzing the processing chips. We debate the software algorithms, the large language models, the data center cooling systems.
We do focus on the shiny objects.
We really do. But as these computing clusters scale to sizes that test the absolute limits of our power grids, the processing power is no longer the ultimate constraint. The true bottleneck is the speed of light traveling through a piece of glass. If the digital brains cannot communicate, the intelligence cannot scale. Consider if the companies laying the physical nervous system of artificial intelligence might actually own the most critical and heavily overlooked real estate in the entire technology sector.